Singapore's REITs are insanely popular with investors here given their tax-free dividends that you can collect on a regular basis. However, with the instigation of the trade war by President Trump, there are massive fears that there could be a global recession this year. That raises the question, which Singapore REITs are best equipped to deal with a recession or a drawn-out trade war between the US and China? Before we dig in, why should you listen to me? Well, I'm Tim from Tim Talks Money, and I've been in investment management and private wealth for nearly 15 years. So if you want to up your money game and your investing game, give me a follow. Let's get started. This is obviously not personalized financial advice, but here are my top 3 Singapore REITs which I believe can best handle a recession. Number 1, Keppel DC REIT. Remember, this is a data center REIT and it has a dividend yield of around 4.8%. This is something that owns 24 data centers across 10 countries, although most of them are actually based in Singapore. Its assets under management are 4.9 billion Singapore dollars. Most recent quarter, Keppel DC REIT actually managed to increase its DPU by 14.2% year on year. That's an amazing statistic given the environment of falling DPUs from most other Singapore REITs. It also has a relatively low gearing ratio of around 30%. Data centers on the whole are a necessity. We all know that, and there's only going to be more spending in Asia Pacific over the next decade, regardless of what tariffs President Trump decides to put on these countries. But 2, Frasers Centrepoint Trust. Now, this is a super reliable retail REIT that actually owns a whole load of woodland suburban malls. Examples of these properties include Nex, Hougang Mall, and Waterway Point. Now, typically, they also have high and stable occupancy rates, given the reliability of tenants in these malls. Distribution of Frasers Centrepoint Trust did actually fall marginally in 2024, and it's currently offering dividend investors a yield of 5.4%. The REIT's proposed acquisition of the south wing of North Point City should also shore up the REIT's portfolio in Singapore. And remember, a lot of the tenants that it has are serving the daily necessities of everyday Singaporeans. Finally, we have number 3, Parkway Life REIT. Now, this is a healthcare-focused REIT that has properties both in Singapore and Japan, with many of its properties in Japan being nursing homes, and in Singapore, it's focused more on hospitals. It currently offers investors a dividend yield of around 3.8%. In the first quarter of this year, it managed to raise its distribution per unit by 1.3% year on year and has an incredibly impressive distribution per unit growth record since it IPO'd in 2007. Management is also extremely conservative and has hedged out its FX risk to the first quarter of 2029, meaning predictable income for investors in Singapore. Do you agree with my top 3? Whack your thoughts in the comments and give me a follow for more money and investing tips.